Oh, I'm muted.
Yeah.
Oh, hi, everybody home. We're gonna get started. Oh, I should stand
Here,
next to you.
you wanna
Oh,
stand next to me?
yeah. We'll get started here. Now I think we're ready to go. But I just wanted to let everybody know, if you have questions, put them in the chat. Is that the best way for them to?
Sure.
Yeah, or you can shout it out if you'd like, but Ash, you can monitor the chat.
Want me to shout them out as they come, or wait till the end for the Q&A?
Oh, doesn't
Oh,
matter.
I thought you were asking. me.
No,
Oh,
I
okay.
was
I
looking
know,
at
I
you
was like,
like,
oh, either way, whatever she likes. So yeah, put your questions in the chat. We'll get to them. Welcome everybody from home. And I see, like you said, more people are trickling in. Thank you so much for being here.
Oh,
This is like I don't know how many times we've done this now, but you're one of our favorite mentors.
Oh,
We're so
sweet.
grateful to have you. And so many people here at the rec, when I told them, okay, we're going to do bookkeeping, accounting, the numbers, like this is a scary thing for a lot of people. So it's so nice to have somebody who just, this is your world, you know it, that you can help. And we have startups at all different like levels of their development, and more people will be coming here in a little bit. So I won't talk anymore. I know we do have people from SCSU who are going to be leaving around 5:50. So
Okay.
That's it. I'm going to let you take it
All
away.
good,
You know what
all
you're doing,
good. Well,
Jennifer. Yeah.
If you want to wait till more people are in the room, we can do that. I can always went too fast. So I can always put my bio up in case people feel like reading that while waiting.
Kind of trickle in and now.
Trickle in.
Yeah.
Cool. How's everybody doing?
Good. Here's a clicker if you want for your presentation. With the
Oh,
buttons.
that might be
And
easier.
Make sure you stay on the X, because if you go a little too far that way, they could be on the screen.
I can see if I can see myself there, right?
Yeah, you can see yourself right there.
Yeah.
In the top. There you go.
Thank you.
I look very dark.
I know.
That's okay.
We have another camera going.
When you're not looking at yourself, I promise your face lightens up. Like you face that way.
Yeah.
It lightens up a little bit.
Well, that'll be my first recommendation for
Right.
your
Lighting.
funds is
Right.
amazing lighting
Right.
for your
Look
video
gorgeous.
presentations.
Gorgeous.
Yeah.
Yeah.
Can they make me look thinner too?
We can do this. We can do anything now. AI. This is a new world we live in.
Oh, I love AI. I've been doing a lot with it lately.
Every day.
You know, oftentimes running an accounting firm, I'll get really long emails from people, whether it's staff or referral partners or clients, and I'll get these really long emails. And I've been using Claude, CLAUDE, Claude AI, and I'll put the entire email into it and say, please summarize this email for me and help me draft a response if I want to say X, Y, and Z. And in 20 seconds, it drafts an amazing response for me. And I'm like, God, I love this. Saves me an hour every single time. Not every single time, but as often as possible.
We're using it
So
a lot, and I feel like I'm feeding the machine, and it's scary sometimes, but I love it. I'm already become addicted to it.
yeah,
Yeah.
I know I'm getting more and more
Yeah.
addicted to it. So anyways, how's everybody doing today? I'm supposed to stand right on the X, but I feel like
No, you can stand wherever you want. You're fine. There's another camera.
Ash is
here.
gonna get mad at me. I'm just kidding. All right. Well, we don't need to go into too much about me, but I have run 2 outsourced accounting companies at this point in my life. And the second one, Optima Office, we have about 100 W-2 employees currently. We're doing a little over $1 million a month in revenue. And it's just a great industry to be in. We find that more and more companies are wanting to outsource their accounting instead of having one full-time person trying to do everything. It makes a lot more sense to have the right people doing what they're good at every level. And so we have about 35 controllers at the company, and they're the people that really lead and manage accounting departments. And if anybody doesn't know what a controller does, controllers are generally responsible for the production of financial statements, making sure they're accurate, budgeting, cash flow forecasting, and making sure every single person on the team is doing what they should be doing. And I was a controller for about, I don't know, I won't age myself, a long time. And then I've been running a company now for about 12 years. So I actually don't do accounting anymore, but I can speak to it. So don't ask me super hard questions, but I can probably answer most of them.
Right.
One of my favorite awards that we keep winning, both of my companies have won year after year, is Best Place to Work. And one of the reasons I really love the best workplaces, Best Place to Work, we win it with Union Tribune, San Diego Business Journal, and Inc. 5000, the Inc. publication, is because you can't game it. Your employees actually have to really like you and have to really enjoy working for you. And with 100 people, you need to get at least 70% of those people to say nice things and to really buy in on you. So I feel good about it's a validation that we're doing the right things and treating people well. by continuing to win that award, those awards. I do like fastest growing too, because that's kind of a cool one. Those Inc. 5000 awards are just really fun, cool groups. Actually, I went last year, Ryan Reynolds spoke, and I was like, I'm gonna go just to see Ryan Reynolds speak. How cool is that? So I mentioned what a controller does. I am not one to read slides, so please take a gander at this yourself. I did go through the controller one already. Bookkeepers and staff accountants are also needed at every company, and they're really responsible for recording transactions, making sure the books have been kept, right? Bookkeepers, and they are ensuring that all the transactions are being recorded into the right buckets. They do bank reconciliations, credit card reconciliations, and most of the input they get should be from a controller. What I find with a lot of bookkeepers is they don't utilize the balance sheet enough. And you really have to utilize the balance sheet in order to have proper books. And if they're running on cash accounting, a company's running on cash accounting, that's somewhat problematic because they really don't know what their burn rate is. They don't know what their break even is. They might pay an insurance bill in a month for $16,000 when the entire year might be $24,000, and they pay another $8,000 throughout the year. And the problem, let's say they paid it in May, $16,000 for insurance in May, and they just expense it as insurance expense. Well, what happens there is that you didn't really have a bad May because you paid your insurance bill. You just have a bad bookkeeper. So it's putting that on the balance sheet as a prepaid asset because it's prepaid for a future service. And then you want to pull $2,000 a month from the balance sheet account. So the insurance expense is actually $2,000 per month, and the rest of it goes into prepaids. And that's just a very simple example, but there's probably 100 of those examples. And so if you compile everything and all of the expenses were paid in May, it's just, you didn't have a bad May, you just didn't record everything in the right month. CFOs, we have about 15 CFOs on our team, and they're mostly strategic and forward-looking. You don't want your CFO to do bookkeeping or lower level tasks, although some of them will if they have to. They need to know what's going on at the lower levels, but they're really about strategy and advice and making sure that a company knows how to get where they're going. They give advice on strategy, and it might be compensation analysis. It might be forecasting, might be scenario building. And so they are very important, especially for larger companies or those seeking fundraising, those wanting more investors. If they want to do a merger or acquisition, that's one reason you would need a CFO. And then completely separate is a CPA firm. They really should just be the check the box, the company's doing a great job. Now let's advise you on the most tax advantageous situation. We do run across CPA firms that do bookkeeping. I think the big gap there is there's not a controller between the CFO, the CPA, the bookkeeper. Having that middle level person is key. Yeah, you had a question?
That X number of CFOs that your firm, is it like a fractional CFO that you work? It's someone for your firm that you has that work.
Fractional CFOs, yes, we're a fractional firm in general. And so you might use one of our controllers a day a week or 2 days a week. You might need a CFO 1 day a week or 1 day a month. All the services are fractional, and fractional really just means part-time. Some people get confused with what fractional actually means, and it just means they're not your full-time employee. We have 100 W-2 employees at Optima, and we fraction them out to various companies. One CFO might have 10 clients that they serve at Optima. A controller might have 14, 15, 16. The lower level people usually have 2 or 3 or 4 clients because they need them more time. All right, some questions for everybody. Zoom land, you're welcome to answer the questions as well. I don't want you to just blurt it out, but maybe just blurt it out. I can't see you.
Yeah.
I don't know if we should change it to the show grid. Okay. If you have a question, I'd prefer you put your camera on, and if you're answering a question, let's keep your camera on. So I don't want to, that's what's going to happen. That's going to mess up the slide. All right. Why is it so important for companies to understand financial management and understand their financials?
Yeah.
Stay in the green. You can stay in the green though, but not understand your financials because you have so much revenue. and you're still in the green, but you don't know why.
Maybe not pay too much in taxes.
Well, I can attest that I understand my financials really well and I paid a lot in taxes last year. So it's not always an equal correlation. But it's important so you really know why you're profitable, why your numbers are moving, what your gross profit margins are for all your products, services, customers. What, you look at it and one might be 20%, another customer might be 80%, and you're just looking at, oh, I have a good profit margin. But you really want to pay attention to why you're profitable, what your numbers mean. And then you also want to understand your balance sheet. What are you worth? What are your assets versus what are your liabilities? And if your liabilities start getting a lot higher than your assets, you could potentially be insolvent. And so you really want to understand your balance sheet. What about some important metrics that you should know? Anybody have a guess on some good metrics? Monthly revenue. I like the trends. What's my trending total month, for the next 12 months or so, and what's my average over the last 12 months? Yep. Hopefully what your profit is, not your loss, right? Anybody in Zoom land? Give me a metric. Nobody wants to show their face in Zoom land. All right, all good, all good. This is educational, so you guys can just listen to me talk, I guess, but we're gonna go over some financial metrics later on, but financial metrics are the blood of your business. You really need to understand what's happening. And if you don't know the metrics, then it really is like you're flying blind. There's a couple that I really liked, which we'll go over today. Anybody know some of the main financial statements? We've heard balance sheet, we've heard P&L. Are there any other ones, any other financials that you want to look at?
Cash flow.
Yep, statement of cash flows. Statement of cash flows and cash flow forecasts are very different, but you want to understand what is your statement of cash flows and how much cash you have now and how much cash you're going to have in the future. So having a statement of cash flows and a cash flow forecast, understanding your W-2 employee, what's your monthly nut, right? That's going to be in your P&L. We'll look at the main financials in a minute. Yeah. Anybody?
Oh, so did you get balance sheet already?
Oh, yes. I prefer to look at the balance sheet first. A lot of companies prefer to look at their P&L, and that's what they understand is, oh, this is my revenue, these are my expenses, this is my bottom line. But usually if you just have a bookkeeper doing things and you don't have a controller, then your balance sheet's probably wrong, which is your balance sheet wrong, your P&L is wrong. And so we don't like people to look at their P&L until they've really confirmed that their balance sheet is correct. Kind of already mentioned this, but does anybody know the point of a cash flow forecast?
Purchasing.
You keep going. You're on the right track. Make purchasing decisions, timing of purchasing decisions.
Project how you want to use your money.
Best use of capital.
Also, I've known this has happened to me with companies before where I've gotten backside of the cash with like terms and then they don't have enough cash and it's like I can never catch up on cash, even though I've got tons of revenue coming in. It's frustrating. I used to not pay attention to it.
Yeah, it's important, especially for annual expenses. If you're not planning for annual expenses or you're not planning for a potential downturn in the economy or something might happen, you don't have a plan B and you don't really know what your cash position is, then again, you're flying blind and you might run into some significant problems in the future. A big point of a cash flow forecast is making sure you can pay your employees. Right? What if you run out of cash and you can't pay people? How many people are going to stay with you? If you say, I'm sorry, I'm not going to meet payroll this week, stay on for another couple of weeks and I'll pay you eventually. Well, A, that's illegal according to California law, but B, people usually don't stick around if you're not paying them. So there's a lot of reasons that you should have a cash flow forecast, but really you want to know the score. How much cash do I have right now? And how much am I going to have even 13 weeks from now, which is a quarter. So you really know the score. We'll go over more of this in the presentation. So there's two primary types of financials, and I realize this is a Zoom thing. Maybe if I put it
I know they try to
near
find
my
the perfect
logo,
spot
because
for
my
it.
logo kind of, nobody cares about that. We've got two primary types. We've got financial accounting statements and we got managerial financial reports. The financial accounting statements are really looking in the past. How did you do? What did you measure up against? It's a historical picture of what's happened in the past. You want it to be done in an accounting software. So, you could use Excel while you're small, but you eventually want to get into at least, QuickBooks. As you get larger and may have inventory, you might want to get into a more robust system that has inventory reporting. QuickBooks inventory is terrible. I won't go into the reasons, but mainly it only does average weighted. And if you're doing first in, last out, or let's say prices are going up or prices are going down and QuickBooks is only calculating the average, then you're really not knowing what your gross margins are. But yes, any accounting software, just have it, make sure you use a software. And when you're getting financing or investors want to invest in your business, or you need to go to a bank for a loan, they're going to ask you for your P&L, your balance sheet, and maybe your cash flow forecast. You do want to review those monthly, ideally between the 10th and the 15th. I typically get mine every month by about the 12th. And our VP of accounting does a really good job of giving me a pretty nice financial package. So even if it's a small financial package, you want something to look at and analyze, ideally charts and graphs.
Yes. What if you don't have a lot of money and you don't have like VPs of accounting? You know what I mean? Like, I feel like so often when you're in the beginning, you're just like treading water.
In the very minimum, I would say having a bookkeeper, even if it's 6 to 10 hours a month, and then a controller, you can outsource, find a controller that'll work 2 to 4 hours a month. And it's not much if you can spend, even $400 or $500, $1,000 a month to make sure that you really have a good foundation so that you do start growing, the score.
Yeah.
You really know why what your profits are and how much you need in revenue to break even. Let's start with the financial accounting statements, the P&L, the balance sheet, and the statement of cash flows. We're not going to do a lot on the statement of cash flows. It is a more complicated report to put together, but I will talk to you a little more about the P&L and the balance sheet. Again, I don't read slides, so please take a quick look yourself. Let me know if there's any questions. I don't see anything in chat. And now it's covering up important stuff. So you know what, I will go back to the thumbnail. Okay. Here's a little more about the P&L. I think everybody understands what income, expenses, and gross margin are. One of the things with your gross margin is we want to make sure that everything that's used to sell your product or service is put into cost of sales or cost of goods. Many companies put things like merchant services down in G&A. And then I asked them, well, what if you had no sales? Would you have merchant fees? And they say no. Okay, well, then it's cost of sales, right? It's ties right to your sales. And so anything that ties directly to your sales has to go in cost of goods sold. That makes sense, right? Okay. I just ran into a restaurant. Well, they're a client. They're now a client that had so many things below the line, like their delivery drivers to deliver food. Like, well, that's a cost of sale. What if they had nothing to deliver? It's obviously cost of sales. So understanding what makes up your cost of sales or cost of goods, and then knowing what your gross margins are is a really critical number. And not just knowing your gross margins at a high level, really knowing all the products and services and customers. What is your gross margin per product, per customer, per service? Yeah.
So the challenge I have with the cost of goods sold is it's when you move it from inventory to
When it's sold, it's in your asset. It's in an inventory asset until you sell that piece of inventory, and then it becomes that cost of good when you record the revenue. It's directly tied to when you record the revenue. All right, here's just an example of a successful company. Let's call it around $200,000+ a month. And their cost of goods sold is usually around 45%. Let's call it 48%. But what happened in August and September? Anybody see a problem with August and September? Well,
It's a high percentage.
August is the lowest gross margin that they've ever had. And September is the highest gross margin they've ever had. That to me tells me there's a timing problem. They're recording revenue either before or after they should, or they're recording costs before or after they should. And so if you have a timing problem, you're going to have your gross margin swing. And if you see a companies whose gross margins swing and they don't know why, it's probably because something's in the wrong period. Now, it looks to me from this that September has a little bit too much revenue, and maybe some of that should have been in August. Or maybe they're recording payroll expenses or something else in August that probably tied to September. And so it's really understanding the timing. You have to put it in the same period, which is another reason why cash accounting can be so problematic, because you really don't know what your gross margins are.
And what happens, I mean, what's the ramifications of this? Like, why is this so bad to see these swings like this?
Because you really don't know what it costs to run the company.
Yeah.
What's your gross margin? And your gross margin should be fairly steady. It should be predictable. I think one of the things with understanding your financial statements is how predictable are they? How well can you predict out the future? How well can you predict out your margins? I know what my margins are going to be 6 months from now. And if something changes, if my margins shot up 6%, yay, that'd be great. But that's not going to happen because they're very predictable. Yeah, do you have a question? Somebody had a question?
I
Oh.
would say, I mean, what if your business got like super popular, and then you made a big spike in sales and it just went like that?
Well, your cost of goods would also probably be correlated to that. Unless, let's say there's a service that you sold that really didn't have any cost of goods associated with it. Sometimes we do recruiting fees, and those might be pretty big. And our gross margins on recruiting fees are pretty high. And so if we did 5 recruiting engagements in 1 month, that would probably make our margins shoot up. I guess I was incorrect that it couldn't go up 6%. I guess if we did a whole bunch of recruiting engagements, it could, but I would know why. But you see what happens is, you know, you look like you had a really bad August. See, it's
Yeah.
0. You broke even in August, but then you made a lot in September, but that really wasn't true. And so you're looking at bad information.
So what if you're like a seasonal business? Like if you're a seasonal business where, you overload, or you like accumulate a lot of inventory, and that's also your low time. And then after that, then you spike up. If it's something that's a yearly occurrence because it matches your industry, is that okay? Or is it still?
As long as you know why, and your cost of goods sold would probably also shoot up if your revenue shot up, because if you're selling a bunch of inventory, then that probably means that the cost of that inventory was also related to those sales. Unless you're doing maybe a flash sale where you're just offloading a whole bunch of stuff. But that might make your margins lower because you're not getting the gross margin you had expected. You had to reduce the price of your goods to get rid of them. I've kind of gone over gross margin already. Operating margin is after all of your general and administrative. So you've got your gross margin, then all of your fixed costs, that then is your operating margin. And then your profit margin, you divide your net income by your revenue, and that's your profit margin. And sometimes there's economies of scale where the higher revenues that you have, the more your profit margin goes up. It's not always just, oh, I earn a 6% profit margin. Well, if you doubled your sales, you might already be covering your monthly nut because you've already covered all your fixed costs. So that could really increase your profit, your profit margin. And then EBITDA is the next step of earnings before all your interest, tax, depreciation, and amortization. And a lot of companies do focus on EBITDA. They want to know what their EBITDA numbers are. And a lot of companies that sell, their sale is sometimes tied to EBITDA.
I have a quick question.
Sure.
So like, what software do most companies use? Is it mostly just QuickBooks that they're using for inputting all this? And because you know what I mean? Like is there something better?
Well, I would say, small businesses are likely going to use QuickBooks Enterprise, QuickBooks Desktop. We also see a lot of Sage products, Sage 100, Sage 200, Sage 300, Sage Intact. Sage bought a bunch of other platforms. So they bought Timberline, I don't know, they bought a bunch of them. So Sage doesn't necessarily mean a one size platform. There's all different types of Sage products. There's also, if you're in property management or real estate, you might use Yardi, you might use MRI, you might use Appfolio, which I don't love Appfolio. It's kind of a cumbersome software, but Yardi is probably one of the more premier real estate type softwares. There's also Rent Manager. If you're working with the government, you might use Deltek or Uninet. You know, you want, and then there's also NetSuite. NetSuite is probably one of the more cream of the crop softwares, especially with a lot of inventory, but it's expensive. It can be $150,000 to $200,000 to implement NetSuite. And so a lot of companies might use Fishbowl instead to supplement on top of QuickBooks if they have inventory, because QuickBooks isn't an ideal system for inventory. But there's a whole bunch out there. We have 300 and let's call it 350 clients at Optima, and I would say 65% of our clients use QuickBooks. But that's not 100%.
No.
So it's definitely, it's a majority, but
Cost, like the rate of it,
Like when you're not a student.
or if you are a student.
Yeah,
You know,
it's-
they raise the prices. I mean, QuickBooks is really trying to get everybody away from desktop, and they're trying to push QuickBooks Online subscription. I believe it's like $70 to up to 70 to $100 a month, maybe for 1 or 2 users. Yeah, I think that's right. Yeah, I don't,
Student version.
probably a student version. I would recommend
You
it.
get a student discount. I can't remember what it is, but it's significant. I used to get it for free, but I don't remember. It's significant. It's more than 50%.
Here's a balance sheet basics. Really, your balance sheet is what are you worth? Your assets are what you own. Your liabilities are what you owe. And you really want your assets to be greater than your liabilities. Because if you were to sell everything you had, and then you were to pay off all of your debt, what's left? And what have you accumulated over the years? That's your net worth. That's your retained earnings. And you want your equity to go up over time. So is a key number to look at. Here's a balance sheet. I put one that has potential errors because I think that's more helpful than showing you a pretty balance sheet. This would have been pretty up until it got to maybe August. What kind of give the answers in the notes section, but why would you not want your bank balance to stay the same every single month? Maybe somebody didn't reconcile it.
And
I mean, did you pay no bills that month? Did you pay, what happened? Why would and so if you see a bank account not moving, you might want to look at the reconciliation reports, what happened, what sales, how did sales get input? What expenses got paid? You might have a money market account, and if you do, you're probably earning interest on it, and that money market account's going to go up. Most accounts on the balance sheet should move every single month. And if every single month balance sheet accounts don't move, very likely the profit and loss statement is wrong. You want to know the details. So if you've got prepaids, well, what do those make up? Is it prepaid insurance, prepaid dues, prepaid events, prepaid inventory? You know, what did you buy? What was prepaid? Now, if you look at August, you look at accounts payable. Do your vendors actually owe you money? Did you overpay something? So if it's a negative, well, that doesn't make a lot of sense. So you want to understand what's going on the balance sheet, and all the numbers need to be moving in the right direction. If you look at payroll liabilities in July, it shot up a ton. Why did your payroll liabilities shoot up? Well, you could have accrued bonuses. You could have forgot for the last couple of years to take into account of employees' PTO. So I actually talked to a company yesterday. I won't name names, but they had 25 employees, and their average employee makes about $50 an hour. And they give their employees 2 to 3 weeks off based on tenure, and they had no payroll liabilities. And I said, well, that's interesting. Why don't you have any payroll liabilities? Well, why? We just pay out the payroll when the employee quits. I said, okay, well, what if something happened and 5 people quit? Would you have the cash to support that? Do you know what your payroll liabilities are? And they said, well, no. And I did quick math, and it turns out it was about $88,000 that they should have had as a liability on their balance sheet that they didn't. And so I think the call ended with them hiring us, but you know, at the end of the day, you got to point things out to people and you have to try to make sense of it. And, you know, if you have employees, you give them PTO, you have a payroll liability because when those employees quit, you have to pay them out. Or when they use their PTO, you have to apply that towards their payroll. So those are just some key things on the balance sheet that people don't always take into consideration. If a business owner is taking out distributions, that's fine. They need to have a positive tax basis, which means they need to have positive equity in the business in order to take out money from the business. Otherwise, that doesn't make a lot of sense. You can't take money out of a business that has no equity. There are some significant tax consequences to that. But you want to make sure that distributions get closed out on 12/31. And so if distributions just keep accumulating over and over for years on end, then that's incorrect. They zero out and they go into your retained earnings. So every company at 1/1 of whatever year they're in need to have 0 distributions and start from scratch. And those get rolled back into retained earnings. That makes sense? We see this all the time. So anybody that takes distributions, make sure that that number is 0 at the end of the year. Net income also rolls into your retained earnings at the end of the year. So these are actually Optima, our balance sheet schedules. So there's nothing too confidential on there. But that's a lot of balance sheet schedules. Does anybody find that surprising that there's that many balance sheet accounts? We've got bank reconciliations. We've got accounts receivable reconciliations. How much do people owe us? We've got accrued revenue, allowance for doubtful accounts. We've got deferred expenses. We've got, a fixed asset schedule. We've got credit cards that need to get reconciled, accrued expenses, customer deposits. We have an accrued 401k match. We have deferred rent. We have accrued taxes. We had a shareholder loan for a while. We paid off. So these are just an example of a professional services company that our business is fairly simple, but that's how many balance sheet accounts I personally have at my company. And so really take into consideration what it takes to put together a balance sheet reconciliation and have a balance sheet schedule. Because even if you look at my prepaid, I think prepaids are the ones on here. That's a lot of prepaids. We've got 100. Other prepaid expensive. We've got $209,000 in prepaids just on this one balance sheet account, and all of them need a schedule behind it. Kind of already mentioned that about every general ledger account on the balance sheet should move every single month, with the exception of security deposits, maybe a long-term principal loan balance, and retained earnings, but that will change at the end of every year. Inventory should be changing every single month unless you don't sell anything for 90 days, but that's tough unless you're a Ferrari dealership and that makes sense. You might not sell a Ferrari every month, but make sure that you're really taking into account inventory and doing a physical inventory and understanding, what is the value of that inventory? Does it need to be reduced? Is it still sellable in its current state? And if you're a restaurant, many of you you understand that industry well. If you're not taking inventory weekly, what if your cheese goes bad? What if you have $20,000 worth of fancy cheese on your books and it starts spoiling and you don't do a reconciliation of your inventory until the end of the month? Well, it's too late. Cheese is already bad. Throw it away. If you have multiple locations, maybe one location wants Gouda cheese and the other location really likes pepper jack, and you could actually have somebody go drive the pepper jack over to the other location to make sure it's sold. I mean, that's maybe a silly idea, but you have to understand what's happening with my inventory and how do I get rid of it so it doesn't go bad? And so for some industries, it might even be a daily inventory check. Fixed assets. Oftentimes I worked for I was the controller for the San Diego Model Railroad Museum, and I cannot even tell you how many things they had on their fixed asset schedule that did not exist. I actually walked around and said, show me it. Show me what is this on the balance sheet? I want you to touch it. I want you to show me where that exists. And they couldn't do it. There's hundreds of items that had just accumulated over the years. Nobody had written it off. And I'm thinking, guys, I get it. You're a railroad museum. You might not care about this, but your assets are way overstated because you've got things on here that literally don't exist anymore. And so when it's a fixed asset, you need to be able to go find it and touch it. If you can't find it and touch it, write it off. It probably doesn't exist. And you should also consider the useful life. It might still exist, but what was the useful life? You know, on a computer, it might be just 3 years. But if that computer is still sitting on the books in year 5, it probably needs to be either written off or fully expensed at that point in time. We've already talked a lot about prepaids. I showed you my fun prepaid schedule, which has a lot of items. Thankfully, I'm not the one that has to reconcile that. And we already talked about cost of goods sold, but I think the real theme here is making sure that your numbers are correct. Here's just a few ratios. I didn't want to overwhelm you with too many ratios. Your current ratio is a really good one because you divide your current assets divided by your current liabilities. Now, your current assets are anything that you can liquidate within 1 year. Your current liabilities are anything you owe within 1 year. 1 year is really the key theme here. So if you divide your current assets by your current liabilities, if it's less than 1, fix it, because you could potentially be insolvent. That means you have more current assets and current liabilities. If you were to liquidate, you couldn't pay off all of your current debt. Nobody likes to be in that position. Unless you're a student with a startup and you're going to do very well in the future, but just know that that's something to pay attention to. Quick ratio just takes out inventory. Same ratio, but takes out inventory. I love this ratio. It's called DSO for short, but it's days of sales outstanding. And it's really about how long does it take your customers to pay you. Companies that have cash flow problems might have a DSO problem. That means they're the bank. They are financing their customers who are taking way too long to pay them. Might take them 45 to 90 days to pay them. That's not ideal. And so getting your invoices out quickly and getting your customers to pay you quickly is very important. So just keep that in mind in terms of making sure that you're paid quickly as quickly as possible. Negotiating that up front. I mean, you might even want to take a deposit or a retainer, or say I want half of it up front, and then I'll give you the other half once the product or service is delivered. But your days of sales outstanding, it's a pretty easy number. You take your accounts receivable balance and you divide it by your daily sales. Anybody have questions about any of these? Inventory turnover is how quickly are you selling your inventory? Typically a good, under 45 days is probably ideal, depending on your industry. Unless you're selling cheese, then you might want to sell it faster. Unless it's blue cheese. Yeah. We'll move on to managerial financial reports. And this is really how you run your company on a day-to-day basis. Every company is going to have different operational metrics. A manufacturing firm is going to have far different metrics than a professional services industry. I really care a lot about utilization. I want to make sure all my team members are utilized. I want to make sure that my administrative costs are not super high. If I've got one employee spending a lot of time on administrative and I've got another employee who spends 2 hours, I'm like, well, what are you spending so much administrative time on? So that's just an example, but you want to make sure you have the right key performance indicators for your specific business and maybe measuring against the competition. Here's some examples. I mentioned utilization, profitability by product or service. I do have an example of that. Some KPIs that are important for most companies are going to be your break even. What do you have to bring in sales in order to break even? What does it cost, your customer acquisition cost? What does it cost you to obtain a new customer? What's the lifetime value of those customers? I already mentioned DSO. If you have inventory, you want to know inventory turnover, your current ratio, your debt to equity ratio. So these are some important ones that are managerial in nature. Here's a report. I don't know why that went all the way on the left. There used to be something on the, anyway, doesn't matter. Year-to-date revenues. This is the percent margin by customer. So you want to know, what is my gross profit by each of these customers? And for each of these employees that are working on these customers, what are their utilization numbers? So this is just everything in a pie chart. Anytime you could put things in a chart or a graph, just kind of makes it easier to digest.
Those numbers make me nervous. They really do. When I look at them, I just get like my heart rate goes up. Yeah, totally.
This is why it's so important to have your profitability by product or service. Now, a lot of companies, and if you're a salesperson, you're like, I really want to sell as much as service two as possible, because if my sales compensation is based on selling a lot of dollars, then I'm going to sell service number two. Well, the problem is service number two has a lowest margin at 20%, and it doesn't even cover all the SG&A, which is also 20%. So you're literally breaking even on that service or product. And if you are paying people as salespeople, or you might be losing money on this one, but you're just breaking even. So you might look at service number two and say, oh, wonderful, there's an 80% margin. I want as many of that. I'm going to make all my salespeople sell service number two because I have a really high margin. Well, what does anybody know what a problem with that might be? Well, I think there's somebody in the chat. Do they have the answer? Any open source or emerging AI programs you've heard of? I'll get back to that one. Somebody had a, no? Okay.
Might have a high margin, but it's not a lot of money. Maybe.
No, but that's a good point. Customer competition is going to probably come in and undercut you.
Oh.
So you might be making too much money on this customer. That might be some of your bread and butter. So what if you've got some really big companies that make up 30, 40, 50, 60% of your sales, and you're making too much money on them, and a competitor comes in and say, hey, I can give that to you for less. I'll only make a 40% margin on you. What's your customer going to do? They're probably going to go where they're going to save some money. So too high of margins are dangerous because you don't want your competitors to come in and undercut you. Too low of margins are dangerous because you might be barely breaking even. But service number one might be your lowest revenue, but you've got a 40% consistent margin. And so that's a service that you might want to sell and you might want to focus on.
And how do you create this? Do you just go through and you do the numbers, plug the numbers?
You can use class codes in QuickBooks to actually allocate everything to a different class. All your expenses, all your time goes into a class code. You want to make sure you have a good timekeeping service. If you have employees that are, specific to different projects or services, you want to make sure that they're recording where they're spending their time.
Okay.
And then if you have materials, you want to make sure that those materials are allocated properly.
Keep better track of stuff than I do.
I think the clicker doesn't like me anymore.
No. Did it stop working?
Numbers that you have, but
Oops.
Yeah, it was tired of the numbers.
Let me see. Oh, it was maybe a user error. I don't know. Did I go that through? Okay.
What happens when I click off? I don't know.
Anyway, figured it out.
Kimmy had a question.
Yeah, so back to class.
Oh, you're hiding over there.
That's the challenge we're having because for our business, we have basically 3 different departments. We have agriculture because we raise bees and we collect honey.
Yeah.
So then we also package, and then we also source honey,
Yeah.
and then we also retail and wholesale.
Okay.
And we're speaking to our advisor, he said that looking at our balance sheet and profit, he said it's really hard for you to tell where is your, like, how much does it cost you from the beginning and then to the end, and I don't know where to start with how to figure out our profit.
Yeah, agriculture a little complicated. We have a flower farm that we've been doing business with for a very long time, and we do it by weight, by volume. So you might want to allocate it out that way. You might want to use an allocation tool to say this is how much weight or volume was sold, and how can I appropriate that to the revenue? Could be a percent of revenue. There's a few different ways to do it, but that is a more complicated one to manage for sure. I would probably look into the weight volume. These are some KPIs for a professional services firm. That's easy for me because I'm a professional services firm. I won't go into this too much, but I just want you to kind of get the gist of what different KPIs could mean for different types of businesses.
The thing I think is how long do you spend like tracking the KPIs? You know what I mean? Like, does it take a lot of extra? Or is it just that I don't know what I'm doing?
Well, somebody asked about AI tools, and you could take your financials and you can put it into like Claude or ChatGPT. Just don't put your company name, because obviously that's open AI and that's not confidential or private. But you can take the information and you can use it in an AI tool to get you some charts and some graphs and some tools. You have Copilot, you've got Gemini, you've got some of those tools that are automatically. I think Copilot's already in Excel, and you can say, you can click on it, give me a chart based on this, like you're talking about revenue, and here's all my revenue. Gemini, can you create a graph on that? And it should take about 20 seconds.
Yeah.
So, you can use AI tools to get you charts and graphs and summary level data. You can put 3,000 cells of data, just copy and paste it into Claude. I like Claude, for example. It's one of my more favorite tools, but you can just stick it in there and say, hey, summarize this data for me, give me a chart, give me a pie chart. And it does it very, very quickly. So lots of them out there. There's some that do cash flow forecasting. I don't necessarily have any favorites. I do use a lot of Power BI, Power Pivot, Power Query. Those give you a lot of great information fairly quickly. As students, I would learn Power BI as much as you can. Learn Power BI. It is the most technologically advanced database I've ever used, and I've been an accountant for, I don't know, 25 years.
It's intimidating though, or is it?
Yeah, can
Yeah,
be.
when you say technologically powerful, I just think, oh.
It's a Microsoft Fabric tool,
Okay,
so it's free.
okay.
You just have to understand how to use it.
Mhm.
At Optima, we have our payroll system, our CRM system, our QuickBooks Enterprise
Mhm.
system, our HR platform,
Mhm.
and one other that all of it ties directly into Power BI. And so I don't have to log on to any of my systems. I don't log on to HubSpot for,
Right.
I don't log on to payroll. I don't log on to any of my systems. I literally just log on to Power BI and it tells me everything I would ever want to know about my company. Yeah. Yes,
Is this a database or is it just a business people?
it's a database. Yeah, it's got a data lake included in it. And so you can just, there's API tools that are take it from different platforms and put it into Power BI. And then it's real time. So it's always there. Here's some KPIs for just visual on what graphs and charts look like. This was actually I put my average daily revenue by month from a couple of years ago data. And so you kind of see the by month. Yeah.
Yeah, it's nicer. I like that so much better than the.
I like that we're about
Yeah.
$52,000 a day now, but
Oh, jeez, Louise.
just about over, but I wanted to just give you a couple of, oh yeah, go ahead.
Spell that out in the right list.
Which one?
Which one? Power.
Just power as like POWER and then BI for business intelligence. Yeah, Power BI. It's a really cool, take a course on it, just learn it. It's really powerful. I wish I had access to Power BI when I was a controller back in the day.
I bet there's some good online classes too that you can do, yeah.
Yeah, and I mean, even if you're really good at Power BI and understanding just getting even QuickBooks linked to it,
Yeah.
that can give you a lot of information, or getting a payroll system linked to it, or billing time. That was my other one, a timekeeping system that I have linked to it, and I get a lot of information from that. You might not know how to do a HubSpot. Like our VP of accounting built our Power BI database, but all the language and the coding language to get that to get HubSpot into Power BI, she was like, I need a developer. I need somebody to come in and help me with that. But I think we spent a few $1,000s and they helped her link it together. And now we never have to do it again. It's a one-time cost. Here's an example of a cash flow forecast that's tied with payroll. And so if a majority of your expenses are looped in with payroll, you might want to tie your cash flow forecast to payroll. If you want to manage it weekly, you can do a cash flow forecast weekly. What you really want to know is, how much cash do I have now? What do I expect to collect? What is my estimated payroll? What are other standard expenses that I know I'm going to have every single month? What is my ending cash balance? And then maybe I have a savings. Well, if you look at June, you run out of money. Okay, well, that's not ideal. You don't want to run out of money. And so if you are in March and you know that in June you might run out of money, then you can prepare. Turns out that this was because of an event. If you look at the major events, there's $100,000 that this company spent on an event, which is why they were low, but they at least knew, okay, I'm going to be negative if I do this event, and then they can justify it, then they can get a line of credit, they can get some financing for it, and they can really decide whether they want to do that or not. Here's a weekly example. It's a little more simple, but it's what cash do I have at the beginning of the week? What are the collections I'm going to have from customers? What's my balance prior to spending? And you can kind of customize all these open 1 through 8 or 1 through 12 or 1 through 20. It doesn't really matter, but you can kind of put in here what all your costs are going to be, and it cash flows it out. There's a lot of really good AI tools for cash flow forecasting. I'm not going to name any. You can just Google it or use an AI tool to ask them. But you can get QuickBooks tied to a cash flow AI platform that'll do it for you.
Closed AI, so it's not like you're putting all the.
Ah, sure he's out. I don't know. Whoever owns that company, they have all your access
Right.
to all your data. What do they do with it?
Right. So,
And, all right, that's it. Look at that, right on time.
I see questions coming up in the chat.
I know that was a lot. Oh, gosh. Okay. Oh, I saw 16. I thought there were 16
No,
questions. There's only one.
AI, but we kind of covered that.
Yeah. Did that overwhelm anybody? It's a lot of information. I try to keep it
always
fairly
get over-
basic,
If
but
there's anything accounting, I get overwhelmed, but I try not to. I try not to.
Yeah.
I know it makes me feel like I don't know what I'm doing. Every time I do, but
well, that's the point of class. That's the
Yeah.
point of learning, you learn new things that you didn't previously know, and it just, you evolve over
yeah,
the
I
years.
get little tools to kind of fix some of the things maybe that I'm not doing right.
Yeah. What else?
How does, so. Like for a company like mine, I don't even know what we need, like, if you did a controller, like, I know you went over at the beginning.
I know,
like,
I'm so early.
Yeah, it's so early and the numbers are so hard for me.
Yeah.
Me too.
It's like, would you, like, we talk to you, like, oh, based on what you're needing, you should work with X, Y, or Z, is that?
I have a bookkeeper, I have like.
I think your accounting costs should generally be between 1% to 3% of revenue. And if you're pre-revenue or 1% is only $100, well, then it might not make sense. You probably need to spend maybe $500 to $1,000. I mean, there's a lot of companies out there that will do basic bookkeeping for fairly low cost.
You can get students,
But-
the people who just graduated the accounting program here too, we've had them do accounting for startups before. I mean, I might not be getting the absolute most experienced, best bookkeepers, but sometimes it's better than just being.
But what point was a company?
Yeah, what's that?
I see companies that are pre-revenue or, if they're funded well, then that may make sense. Our minimums are $1,000 a month. And that gets, 6 to 8 hours of bookkeeping and 4 to plus hours of a controller, and that's usually sufficient.
The companies are $100,000 a month revenue companies, or anywhere from 30,000 to 100,000.
When you're under $1 million, it's really more about setting up the right foundation for the company so that you don't really have to redo everything or play
Yeah.
catch up and you really always know the score. But
I know this is, I know you help the companies that are a little bit further along, but when you're really.
not always.
Yeah, I know you've helped with a little bit.
We do a lot of nonprofits
Yeah,
too.
yeah. But what I'm always afraid of is, when companies are growing, but still pre-revenue or still, not, definitely not profitable. Is that they don't have, when they get to the point where they're fundraising now, when
Yeah.
they're actually like, seeking funds for safes or something like that they're not gonna be able to, because they're gonna have to redo everything, from before, and they still don't have any capital to do that.
Yeah.
Like, how do you keep yourself sort of safe until you have enough money to really pay for, when you're like funding it yourself? Do you know what I mean?
Just put together a basic budget yourself. What do you expect your sales to be? What do you expect your costs to be? Try to apply that into a cash flow forecast.
Yeah.
What are my monthly revenues? What do I expect from customers to come in? What do I expect my costs are going to be? Are there any annual recurring type of expenses? Your annual insurance maybe? I think insurance is always an important one. If you have minimal insurance, always make sure you have insurance because you never know what's going to potentially go wrong. I think marketing is also a very underestimated cost sometimes. If you want to grow your business and you want you to scale and you want customers to hear about you, you should probably invest in marketing. I think a good marketing number is about 3% of revenue, and that's just for steady maintenance. If you are a startup and you don't have any revenue yet, then you probably want to invest, $1,000 a month or so just in marketing, just because you want, paid advertising, or you want social media, or you want SEO services. It takes a couple years to get your search engine optimization pretty dialed in. And so you want to start investing in that fairly early on. So, people can find you with keywords. Keeping that up. But accounting is, it's kind of like marketing in a way. It's investing in your company and just making sure that you have the right numbers and you know what to look at. Yes.
So along those lines, would you recommend that startups or new companies engage with professionals and accountants, like you, just to set up the books properly. So that
Yeah.
moving forward, they know they're in the right track.
Yeah, absolutely. I would. And there are some companies, I mean, $1,000 a month might seem like a lot. There are companies out there that might be $400 or $500 a month, and they might help startups or incubators out. But having just a little bit of segregation of duties in the accounting department. So not a bookkeeper that's responsible for payroll, bank recs, paying bills, recording revenue. That's human error is very possible. They're not going to focus on the balance sheet, and fraud is also very, very prevalent. You would be shocked at how many companies experience fraud, and it's right under their nose because they have one person doing everything and nobody's really watching them, and they're like, oh, she's so nice. Oh yeah,
She
she's
never goes
stealing
on
from you.
vacation. She never
Yeah.
takes any sick leave. Yeah, well, she's got to pull the money.
We can usually spot fraudsters when I talk to a new client on the phone and they're like, oh my gosh, my bookkeeper is so mean. They don't give me any data. They're always like causing trouble in the office, or just, they don't want to, they're very protective over information. I'm like, why stealing from you? Because mean accountants, if they're like really aggressive and mean, they're trying to protect something. I mean, not always, but we find a lot of fraudsters out there, just like onboard terrorists. They're just like stealing from you under your nose and you don't know it.
Well, I better let the people from
Yeah.
FSU go if they're.
Okay.
Thank you guys for coming. Any questions before I say goodbye to you at home?
Chat
Oh,
from, Angela Stevens.
uh-huh. Oh, hi, Angela.
Yes, she is here. Do you have any suggestions on filing taxes for starters?
Hi.
Uh-huh. Yeah.
Not really.
I think it kind of goes with the bookkeeper, that was kind of it was asked before you went into the train of thought of the bookkeeper suggestions. So, but I was thinking a lot of it, like a lot of our students are, filing LLCs, and, there's a different, when you have an LLC, you have the $800 a year LLC fee to the state of California, but then you also still have to file a tax return for the LLC. So.
Yeah, I mean, even like, I don't want to say H&R Block, but like just get a
Mhm.
basic tax filing service that you trust. It's cheap. If you're not making a lot of money or you're not making any money, you're not paying taxes anyway. I mean, when you really want to start spending money on filing your taxes is when you're making money and you don't want to pay a lot of taxes. So you want somebody that's going to be strategic and help you, look at that. I mean, if you are certain businesses, are you a cash-based taxpayer or an accrual-based taxpayer? And a lot of it comes down to, do you have accounts receivable at the end of the year? For us, we're an accrual-based taxpayer. I mean, I'm sorry, we're accrual-based for books, but we are cash basis for taxes.
Yeah.
Because if I have $1 million in accounts receivable at the end of the year,
Yeah.
I don't want to pay taxes on $1 million that I haven't yet received. So we are cash basis for our taxes. So somebody that can really help you distinguish between the two. I mean, that's a fairly simple one, but
In the beginning, my advice for very early stage for filing taxes, do it. Be careful. Don't incorporate until you're ready to incorporate. Don't pay all of this, because the fees when you don't file your taxes with incorporation is so high, and it gets just out of control. So
incorporating too, you have to take minutes. You have
yes,
to have
it's
notes. You have to
a
actually, yeah.
pain. Yeah. Do it. Yeah. Wait to do that. Anyways,
Yeah.
I'm gonna let everybody go from home. I know some of you are going back to class. I saw some of you
Yeah.
dropped out.
Yeah.
Thank you all
Thank you,
for being
Jennifer.
here. Yeah, thank you. Thanks for being here, Angela. And I will share, the link will be on our YouTube for all of you. So bye, everybody.
Thank you so much.
Yes, thanks. Thanks so much for being here. Bye, everyone.